You just got $10,000. Or maybe it's already sitting in your bank account. And now you're asking the real question. What should you actually do with it? Where should you invest it? And more importantly, how do you avoid messing it up? Because in crypto, one wrong move can cost years. So what's the smartest way to invest $10,000 today? Let's dive in. $10,000 is not just an investment. It's a decision point. It's too much money to improvise, but not enough to recover easily from a major mistake. One wrong allocation can set you back years. So this is where things change. You don't just invest anymore. You start thinking in terms of strategy. Most beginners start the same way. They look for the next big crypto, the one coin that will outperform everything else. But that's the wrong approach, because performance rarely comes from picking one asset. It comes from how you structure your portfolio. Allocation matters more than selection, and the vast majority completely ignore that. Before investing anything, you need clarity. Why are you investing this $10,000? Is it for retirement, financial freedom, or trying to double it quickly? Because each goal leads to a completely different strategy. Without a clear objective, every decision becomes random, and random decisions in crypto usually lead to losses. Time changes everything in crypto. If your horizon is short, volatility becomes your enemy. Prices can drop fast, and you may be forced to sell at a loss. But over longer periods, cycles tend to smooth out. Crypto markets move in phases. Understanding that can completely change how you invest and react. Most people believe they can handle risk until they actually experience it. A 50% drop is not rare in crypto. It happens regularly across major assets. Even strong projects can fall sharply during market cycles. So the real question is not your expected return. It's how much volatility you can survive without quitting. Crypto does not grow in a straight line. It moves in cycles, periods of extreme optimism followed by sharp corrections. For example, the 2021 bull market was followed by a major drawdown in 2022. Understanding this pattern is essential because what feels like failure is often just part of the cycle. Most beginners don't lose because of bad assets. They lose because of bad behavior, overtrading, chasing pumps, going all in at the wrong time. Instead of following a plan, they react to emotions. And in a volatile market like crypto, emotional decisions are usually the most expensive ones. A lot of investors try to time the market. They wait for the perfect entry, the perfect price, the perfect moment. But that moment almost never comes, because markets are unpredictable. You don't win by guessing the market, and nobody does. You win by structuring your exposure in a way you can sustain long-term. Even in crypto, you need a base layer. Not everything should be exposed to volatility. Keeping a portion in stable assets like USDT or USDC or cash reduces pressure. It gives you flexibility during market drops, because if everything is invested, every crash becomes a forced decision. And forced decisions are where most investors lose money. At the core of a crypto portfolio, a few major assets dominate. Bitcoin as a store of value, Ethereum as a programmable ecosystem, and XRP as a payment and liquidity infrastructure. These assets serve different roles. Together, they form a foundation that is more resilient than relying on a single narrative. Above the core, there is the growth layer. This is where investors look for higher returns. Other Layer 1 blockchains, emerging ecosystems, new narratives. But this part should stay controlled, because while upside is higher, risk is also significantly higher. Growth should complement the core, not replace it. A conservative crypto strategy focuses on survival first. The majority is allocated to core assets, typically between 40 to 50% in Bitcoin, 25 to 30% in Ethereum, and 20 to 25% in XRP. This approach reduces volatility while still maintaining exposure to crypto growth. A balanced strategy aims for growth while controlling risk. Allocation becomes more evenly distributed, around 30 to 40% in Bitcoin, 25 to 30% in Ethereum, and a similar range in XRP. The remaining portion can be allocated to other Layer 1 ecosystems. This structure offers both stability and upside potential. An aggressive strategy pushes harder toward upside. A typical version could look like this: 20 to 30% in Bitcoin, 20 to 25% in Ethereum, 30 to 40% in XRP, and 10 to 25% in other Layer 1 or higher risk assets. Here, returns can rise faster, but drawdowns become significantly harder to handle. When investing $10,000, one key decision appears immediately. Lump sum means investing the full amount at once. DCA, or dollar cost averaging, means splitting the investment into smaller amounts over time. Lump sum often performs better historically. DCA reduces emotional pressure. There is no perfect choice, only the one you can sustain consistently. Most people believe they will buy low and avoid buying high. In reality, markets move too fast and emotions take over. Perfect entries usually look obvious only after the move has already happened. That is why timing the market consistently is extremely difficult, especially in crypto, where volatility amplifies every decision and mistake. One simple rule helps beginners more than almost anything else. Start building exposure before you feel fully ready. Waiting for perfect clarity often means missing entire cycles. A structured plan executed consistently tends to outperform hesitation. And beyond timing, structure also includes where assets are held, because taxation and account type can impact long-term results significantly. Holding too many coins create the illusion of diversification while often producing confusion instead. Once a portfolio spreads across 8, 10, or 15 assets, conviction weakens and tracking becomes difficult. For most beginners, 5 or 6 positions is already enough. Beyond that, complexity increases faster than clarity, and discipline usually starts to decline. A portfolio without allocation rules is usually just a collection of opinions. When one asset rises, it quietly becomes too dominant. When another falls, it becomes dead weight. Allocation maintains balance. Without it, risk drifts over time. And in taxable environments, frequent changes can also increase friction and reduce overall long-term efficiency. Going all in on one narrative feels smart in bull markets. It feels dangerous in downturns, even with strong conviction in XRP. Putting everything into a single asset creates dependency. A resilient strategy should survive multiple scenarios. Markets evolve, narratives shift, and even strong theses can take longer than expected to play out. $10,000 alone will probably not change your life instantly, but it can change your trajectory if used as the foundation of a disciplined system. In investing, the first serious capital matters less for its size than for the habits, structure, and decision-making framework it forces you to build over time. You really need to understand that what changes outcomes is not usually a perfect entry. It is structure, clear allocation, controlled risk, consistent execution. And sometimes, even the type of account used matters, because certain structures, like retirement accounts in the United States, can significantly improve long-term tax efficiency and compounding. So the real question is not whether crypto will keep creating opportunities. The real question is whether you are investing randomly or building a system you can follow through full cycles. Because random success can happen once, but consistent results usually come from structure, patience, and decisions that remain stable under pressure. In crypto, the smartest investment strategy is rarely the most exciting one. It is usually the one you can understand, repeat, and survive. If you want to explore the world of crypto, don't chase miracles. Educate yourself, because in this world, a simple click can change a life, but only knowledge can protect your future.